How do the returns of property investment compare to other asset classes? Hi, I am Jaco Grobbelaar, the founder and managing director of Prosperity Enterprises. Many people get confused about the returns on property investment and what those returns actually are. But one thing that you need to keep in mind are that there are actually multiple returns when it comes to property investment. On the one side, you have capital appreciation. That is the value that property is appreciating by every single year. On the other side, you've got your rental yield, and that is the rental income or the cash flow that property is generating. So when you are considering the return of a property investment, you need to consider both your capital appreciation as well as your rental yield. So let's first talk about how you calculate your capital appreciation and how you calculate rental yield. So when it comes to capital appreciation, you would take the current value of the property, you would minus the purchase price of the property, and you would divide that by the purchase price of the property. That is your capital appreciation. But that could be over a number of years. So you would divide it by the number of years that you have taken into consideration to get to your annual capital appreciation average on that property. With the rental yield, you get gross rental yield and net rental yield. Gross rental yield is your rental income or your annual rental income without taking into consideration any expenses and dividing that by your purchase price if it is a property that you want to buy, or the market value of the property if it is a property that you already own. Your net rental yield, which is the more important one because that is the actual return that you are generating, is your rental income less your expenses like rental commission to an agent, levies, rates and taxes, maintenance, etc. So you take your annual net income, in other words, and you divide that by your purchase price if it is a property that you are considering to buy, or your market value if it is a property that you're already owning. Now, when we take our net rental yield and our capital appreciation, that gives us our total return on the property. Even in a slow economy, your capital appreciation and net rental yield still generate very good returns compared to other investments. There's one thing that we have not considered up to now, and that is the fact that with other asset classes, we usually use our own money, but with property, we don't use our own money, we use the bank's money, right? So we are actually accumulating assets or building up an asset base, building up a property portfolio without using our own money. So how do we calculate the return on that? And that is where geared internal rate of return comes in. Now, what geared internal rate of return or IRR measures is the money that has left your pocket. It looks at when that money left your pocket and the return that you would generate on that money that left your pocket over a certain period of time. Now, this is a very important formula because this enables you to compare apples with apples. You could, for example, compare how much money have I put into a pension fund or into stocks versus how much money have I put of my own into a property investment, and what are the returns on each of these investments. Now let's compare property returns with other investments. If you, for example, have capital appreciation on a property of 5% and you have a net rental yield of 7%, that's a 12% total return on a specific property. Now, to reach a net rental yield of 7% is very possible, and that percentage could be significantly higher when you start looking at properties where you can generate higher cash flow, like your multi-lets, student accommodation, short-term rentals, and low-cost housing. Make sure to watch our YouTube video on properties that can generate positive cash flow from day one. Let's look at stocks. Historically, the stock market has generated a return of somewhere between 7 and 10%. Bonds are much lower. The return on bonds are usually somewhere between 3 and 6%. If you look at an asset class like cryptocurrency, you could see a 50% increase in 1 year, or you could see most of your money being wiped out. Cryptocurrency is known to be very volatile in its returns. The thing that makes property investment so much different from all of these asset classes is the solid return that you get year on year, consistently year in and year out. And like I said, if you take your capital appreciation and your net rental yield, it's very possible for you to beat most other asset classes. If you use leverage, which means you are not using your own money, you are using the bank's money, it's very possible for you to generate a geared IRR or a geared internal rate of return of more than 20%. That means that you generate a return on the money that leaves your pocket of more than 20%, which is significantly higher than most other asset classes. One more thing to keep in mind is risk. No investment comes without risk. And even though there is risk in investing in property, the risk is often seen to be much lower than with other asset classes. And this can be seen by the low volatility that we see in property prices, as well as the low volatility that we see in rental from year to year. If you want us to assist you with building your property portfolio and helping you with your strategy and putting the right structure in place, make sure that you book a one-on-one consultation with us at Prosperity Enterprises, and you can do that by clicking on the link in the comment section below. In conclusion, property can generate a great return if you look at the capital appreciation and the rental income that property generates. If you like this content and would like to receive more of it, remember to like, share, and subscribe.